Hello and welcome everyone to the Betashares Flash Economic Update. Implications of recent global banking uncertainty with David Bassanese and myself, Chris Yates. Just some important information as always before we get into today's webinar. Please just take a moment to read through this and just pointing out their past performance is not indicative of future performance, and anything provided today is very much general advice and does not take into account anyone's personal circumstances. So just a little bit of admin before we start. As always, our webinar will be recorded. So if you do need to pop away or want to go back and cover off anything that David covers today, that will be sent out shortly after the conclusion of the webinar. And please do also use that little widget on the side there to write any questions as we cover the different topics today. And again, thank you for all those who sent through questions prior to today's webinar as well. To keep up to date on all the regular content we have here at Betashares, please do go on our website. There's a stack of information there, and also sign up for our insights like David Bassanese's Bites, which comes out on a Monday as well. And you can follow all of this on our social media pages, Twitter, LinkedIn, Facebook, YouTube, and Instagram. So just a quick update on Betashares before we jump into today's webinar. Here at Betashares, we manage over $25 billion in assets across 79 different ETF strategies. And now we service over 800,000 Australian investors. And again, thank you for all those that have taken the time to review and select our fund for your portfolios. The man of the hour, David Bassanese, is our chief economist here at Betashares. He's responsible in developing economic insights and portfolio construction strategies, and is also the chair of our investment committee for our own model SMAs. He's a former economist at the AFR, senior economist and interest rate strategist at Bankers Trust and Macquarie Bank, Treasury and OECD economist, and amongst all that has written a book as well. So David, thank you so much for taking the time today.
No worries, Chris. Great to be with you all for a very topical flash webinar. Just it's a special one-off. We usually do a quarterly economic webinars. I'm sure as many of you out there do know, but when special events arise, we try to be useful and provide extra information. So this is one of those examples where it's a flash update, focusing to some extent on the banking crisis globally, what it means for markets, what it means for and how our markets, implications for our banks as well. And then following on with an economic update and a market outlook. But in the main, I really wanted to address the banking issues that have been attracting so much attention over recent weeks. And just so as a result, I'll just start on that. And I just realized that that's not working. Oh, there we go. All right, yeah, so now, this is a slide, and I'm sure as you're all familiar, Silicon Valley Bank, no one ever heard of this bank a few months ago, but it's been front page news for a while. Silicon Valley Bank blew up, it became insolvent, had to get taken over by the regulators and sold to another bank in the US. It was the largest US bank failure. I think it was like the 16th largest bank or something like that in the US. Largest bank failure since the GFC. Now, one of the issues, just to go into that, this is a chart of the different risk metrics. SIV, Silicon Valley Bank, is up there in the top right quadrant, and it shows you the percent of deposits of different banks that were greater than 250,000, and the importance of that being that they weren't insured. So uninsured deposits, and so if you had an uninsured deposit, in theory, in a bank, went bankrupt, you could lose your deposits, and certainly after the creditors and whatnot have been paid out. So you are taking some risk when you have uninsured deposits. On the horizontal axis was the exposure in terms of unrealized losses. So if they had to sell their assets at a market value, what is the difference between the market value and the current book value of those assets as a percent of the capital of those banks? And as you can see, SIVB was pretty extreme on both measures and had a very high share. Almost 100% of deposits were greater than 250,000. A lot of big tech companies, a lot of big tech billionaires used that bank to park their money. And also it took in all those deposits and basically used that money to buy a lot of fixed rate securities, bonds, mortgage-backed securities, which due to regulatory leniency, or it wasn't required by regulators to market those bonds as interest rates rose and the market value of those assets went down. In summary measure, basically. And so what happened was, when it first initially started to lose deposits, some tech companies needed to draw on their deposits. And also what was going on, and we're seeing this amongst the US in a broader detail, a lot of these deposits typically don't pay a lot of interest. Whereas with the increase in interest rates in the US and the increase in, say, short-term treasury, the yield on short-term treasury notes, and through money market funds, you can invest in those notes, the interest was more attractive. And so they were starting to lose their deposits due to more competitive rates available elsewhere. So in the case of Silicon Valley Bank, once it started to lose deposits, it had to sell some assets to cover the redemptions of deposits. And because those assets weren't marked to market, it had to realise some losses on those assets. It did then announce it was going to raise some capital to cover the losses, to patch up its capital. But one thing led to another, and it led to a deposit run on the banks, and there was rumours went around, Silicon Valley, get your money out before this bank blows up. And then within a few days, there was a tidal wave of money going out of the bank, and it was forced to basically throw itself at the mercy of the regulators, who basically took the bank over. But the bottom line, that's the whole gist of what happened. Silicon Valley Bank, and again, the point of this chart is to show that it's relatively extreme in those risk metrics. Now, there's the good and bad news going forward is that since Silicon Valley Bank blew up, the government, the regulators quickly implemented a plan to say, if you're a bank and you're starting to lose deposits, if there's and you have to, and you would otherwise need to sell assets, which could generate a loss, you don't have to do that. You can come and borrow from us and pledge as collateral for that borrowing those assets at par value. So basically, it short-circuited the need or the risk of a further bank run, where investors would fly out of these banks, recoup their deposits, which would then create a bank run because they'd have to sell assets at a loss, and that would become a negative spiral. So the government, one fell swoop, basically implemented this scheme a few weeks ago on the Sunday, and it sort of limited the degree of further bank runs in the United States. Now, that hasn't removed the problems completely in the sector, and you can see here, this is the change in bank deposits of US banks and the flow of money into money market funds. And these are funds that invest in things like, as I said, short-term government bonds that offer a more attractive interest rate. And so basically what we're seeing is ongoing pressure on deposits from banks, money flowing out of the deposit sector into money market funds. And so they are having to either they need to offer higher interest rates on their deposits to keep those deposits, which then means they need to increase the rates that they're charging on their loans, or they need to rein in their lending. And so we're seeing a credit tightening going on. And in fact, I think I may have a slide here. Yeah, so this is a slide of a survey of the net percent of banks that are tightening their lending standards for commercial and industrial loans to large and middle sized firms. And it's a survey done by the regulators, and you can see that has picked up over the course of this year to be at relatively high levels now. So there is a credit crunch going on, and that's why we've seen bond yields. I can talk about the equity market later, but it's been interesting that the initial equity market reaction to this credit crunch, or the Silicon Valley Bank blowing up, and I could talk about Credit Suisse in a minute as well, was that equity markets initially sold off. They feared a GFC Mark II. Bond yields, again, as to be expected, probably. Bond yields also fell dramatically because basically markets concluded if we're going to get a credit tightening, a GFC, then central banks won't need to aggressively raise interest rates as much as we thought they would, and so interest rates can fall. Now, then the government stepped in and sort of, as I said, limited the risk of further bank runs in the US, but bond yields still remain relatively low because of this ongoing credit tightening that we're still likely to see. So the equity market rejoiced at the decline in bond yields, but sort of disregarded the reason for that decline in bond yields, i.e. the credit tightening and the likely negative implications for growth down the track. So the problem is that the ultimate challenge for global markets, and something I've been talking about a lot in the past year, i.e. high US inflation, the need for inflation to slow and the likelihood that you need a recession for that to happen, that hasn't gone away. All that's happened is that the way in which that may happen has changed. It may happen through a credit crunch rather than the Fed aggressively raising interest rates. And so if it happens through that, yes, bond yields can fall, but it doesn't necessarily save the equity market from the challenges it faces down the track. So the equity market's a little bit, it's sort of trying to have its cake and eat it too. It's rejoicing at lower bond yields, but trying to disregard the reason for that decline in bond yields. So far, at least, corporate spreads, we've just got a chart there. I mean, the equity market, again, the US economy is not in recession. Economic activity numbers are still relatively firm. So you can't point to anything specifically to say, yes, the economy is facing negative growth. It's just the persistence of inflation and what that means that one way or the other, either the Fed will engineer the downturn, or the credit markets themselves will engineer. If the credit markets don't do it, then the Fed will. That is ultimately still the problem we face. Just more broadly, in terms of global banks, the big difference from the GFC, a decade or so ago, was that capital ratios have improved. So this is so-called tier one capital ratios for the major banks around the world. You can see that's trended up over recent years since the GFC. So that's a pretty healthy sign. Now, Credit Suisse, did blow up. It was probably the most vulnerable major bank globally, given its history of bad behavior. Its profits, it was making losses over the past year because it was having to pay out so many fines for all the various bad things it's done in various past years. So it was vulnerable. It was starting to lose deposits. People were getting nervous about the outlook for Credit Suisse. And the Swiss regulators very quickly jumped in and basically took over that bank, and it was a shotgun sale, if you like, to the other major Swiss bank, UBS. And so they formed a merger. So just to quickly limit any risk of bank run, basically the Swiss regulator said, well, that's it for you, Deutsche Bank. You're going to have to, sorry, not Deutsche Bank, Credit Suisse. You're going to have to merge with UBS. Now, ever since then, there's been a bit of a hunt on, hedge funds, opportunistic investors around the world have been hunting for vulnerable banks. It's a bit like, the sort of old Africa documentaries about, where you see the vulnerable deer of the pack, and the sort of the cheetahs and the tigers are looking at that deer and sort of going for that deer. And it's a bit like what investors have been doing with banks at the moment. But most of the banks, as I said, for the reasons of these high capital ratios, the big systemically important banks globally are relatively sound. And I think it was a bit of a run on Deutsche Bank a few weeks ago, but that didn't really amount to anything. And I think, investors have concluded that at the moment, at least, there is no major systemic risk amongst the global banks. In terms of Australia, just look very good. I'll run through some. Bottom line is Australian banks are very, globally, the big systemic banks are fairly sound. They have good capital ratios. We don't face the problem of the billions of dollars in mortgage-backed securities that they were holding in the GFC, which if you mark to market would have wiped out their capital. That's not a problem we're facing. And even the smaller to medium-sized US banks, the mark to market, the assets they're owning that are the fixed rate bonds that they own, which haven't been required to be marked to market. If you're a small bank in the US or small medium-sized bank, you can hold assets, fixed rate securities. If you say you're going to hold them to maturity, you don't need to mark to market them. Whereas if you're a large bank, you do. But those banks, even if they had to market those securities, it wouldn't wipe out their capital. But they are facing pressure on their deposits, and they are tightening their credit as a result. And that is at the moment the main issue. And some people have liked it, and I thought this is a good line. I mean, you talk of bank runs. At the moment, it's more like a bank walk. It's like a slow, gradual erosion of deposits and a tightening of bank credit conditions in the US. So that is the issue there. But Australia, very different situation. So like the big banks globally, still relatively sound, good return on equity. These are some charts from APRA, who do regular reviews of the health of the banking sector. You can see return on equity pretty good. Capital ratios have been rising. You can see here the coverage ratio, the so-called LCR ratio for our banks. They have a liquidity coverage, i.e. the percent of liquid assets, things that can be sold fairly quickly and raise cash if need be, are well above minimum required levels. Non-performing loans, bad debt levels at the moment are still pretty low. I mean, that will change as the economy slows, but that will be more of a cyclical issue. But at the moment, they're starting any likely downturn in our economy from a pretty good position. And here, this is a chart. This is from a recent webinar that we did with Chris Joy from Coolabah Capital, who runs our hybrid ETF. And as he often points out, our banks have very relatively high capital ratios by global standards. And APRA, the banking regulator, has this desire for our banks to be, quote unquote, unquestionably strong. And that means that they're required to have capital ratios well above the requirements of global regulators, the so-called Basel requirements, and as a result, above the averages we see amongst other major global banks. Just in the time, I won't go through this. Just that APRA did a very, John Lonsdale, who now runs APRA, gave a speech a few weeks ago and pointed out the various ways in which we have actually tighter prudential regulations on the banks than you see globally, like higher liquidity ratios, higher capital requirements that they impose. And basically stress testing of our banks for like a major economic shock. So there's a severe economic contraction, a 3% increase in interest rates, a surge in the unemployment rate to 11%, a 30% fall in property prices. That would obviously have a significant hit to bank profitability. Their capital, their losses would equal something like 3.5% of their capital ratio. So their capital ratios would drop by 3.5%. They would then probably need to go to the market and raise equity. But the important point is that it wouldn't wipe out their capital. So even a major economic shock to Australia, more extreme than anyone could envisage, would not lead to a solvency concern, or basically a need to raise capital to stave off insolvency for our banks, which is very important. So again, you're thinking about things like bank shares, people that invest in bank hybrids. The main risk ultimately with a bank hybrid is if a bank becomes insolvent and those hybrids get converted into equity and your equity gets wiped out. As I've long said, the risk of that happening in Australia still remains very, very low, certainly for our major banks. In terms of the economic outlook, I won't spend a lot of time on this, because really the situation hasn't changed all that much from what I've been saying, and there will be another quarterly economic update from me next month. But basically at the moment, yield curves, so the difference between long-term interest rates in the US and short-term interest rates is at an extreme level. The markets are counting on very significant interest rate cuts now from the US Federal Reserve starting later this year. And this is a model that looks at the probability of a recession 12 months ahead based on how inverted the yield curve is, or how low long-term interest rates are relative to short-term interest rates in the US. And basically, given the degree of easing that the markets are anticipating now, historically, that's usually been associated with a recession. So the probability, this is from the New York Federal Reserve, no less, their model has a probability of over 50%, but certainly a relatively high, a higher probability. We've never had a probability this high without a recession happening. So again, if we don't get a recession in the next year, given what's happening with the yield curve, then you can forget about ever looking at yield curves again, because it'll be the greatest miss, in history. And the big challenge for the US does remain this: it's inflation still remains sticky. So this is core services ex housing, the consumption deflator. The latest number for February was a little bit lower than we've seen in the previous few months, at an annualized rate of about 2.5%, as you can see here. But that came after two relatively high readings. And basically, there's been a lot of volatility. I mean, it's hard at this stage to conclude that inflation is coming down in a meaningful way. I mean, I think there's a risk that the numbers do bounce back, even though the latest number was relatively low. And that's because, again, at the moment, the economy still remains relatively strong. Consumer spending is strong. Unemployment is low. Wages growth is still ticking along at a solid pace. And so the risk is that, service sector inflation in particular is going to remain sticky. And as a result, the Fed is going to want to slow that economy. It's going to want to raise the unemployment rate to help bring down wages, to help bring down service sector inflation. That challenge, that problem that we've been talking about for many months has not gone away. And that's hence why I still think, caution is required in terms of the market outlook. And just on that, I mean, it's this chart I've showed in the past. This is that core services measure in orange. The grey line is average hourly earnings growth, and they are both relatively high from where we saw prior to the COVID crisis. And we've never seen, I repeat, never seen a substantial decline in service sector or wage inflation from elevated levels such as today without a recession kicking in, without some increase in the unemployment rate. And so the idea that it's going to miraculously fall without a decent slowing in the economy is what is required for a soft landing still seems less likely. Not impossible. I'm watching the wages numbers very carefully, but again, history is not on our side in hoping for a soft landing. In terms of Australia, look, I think the RBA is done. I thought they might have raised rates last week at least one more time and then more confidently signal that rates would remain on hold at least for 3 to 6 months. Turned out that they saw fit to pause immediately and then leave open the door for a further rate rise. Now, I think that's a messy way of doing things, but I mean, RBA is the RBA, so they saw fit to pause then, but leave the door open for a further rate rise. Now, one of the key catalysts for potential rate rise for the US, for the RBA, will be the March quarter CPI that comes out in a couple of weeks' time. If that is high, if it doesn't show inflation easing, then the RBA will probably raise rates in May. But we've had a few monthly CPI numbers which have been benign. They have shown the annual rate of inflation coming down. If that is reflected in the quarterly CPI, then I think the RBA will basically conclude it doesn't need to raise rates in May either. And then I think it'll pause for a while. And as it assesses the data, there'll be more signs of a slowing in growth such that they probably won't need to raise rates again this cycle. So I don't see another rate rise. And in fact, I see rate cuts in the very end toward the year, around November, December time. Just a couple of charts on this to show you that one of the reasons that the RBA didn't do as much as the Fed and why it's on hold somewhat earlier than the Fed is that although the RBA has aggressively raised policy rates, as you can see here, not as much as the US, but certainly higher than some other countries, we've had quite a notable increase in the average interest rate on all mortgages in Australia. And that's because most mortgages in Australia are variable, are not fixed. And just look at the difference between Australia and the US in terms of the average increase in mortgage rates. So the transmission and again, in the US, most mortgages are fixed. And so if you fixed a mortgage for 30 years, you don't really care what the Fed's done with interest rates over the past year, because your mortgage rate has not been affected. And the other challenge for our economy is that the massive increase, we've had this surge in fixed rate home loans during the COVID years of 2020, 2021. They are now maturing and they need to be refinanced either into a new fixed rate loan at a higher rate or a variable rate loan also at a higher rate. And that is going to hit another slice of households over the coming year. And there's some numbers here. 590,000 actually got refinanced last year. That'll jump up to 880,000 this year, and that is going to start over the next few months. Now, there's some estimates of what that does. I've got it here. Basically, I dug this out of an RBA research report. So this is, again, just to understand what this is the average interest rate across all mortgages in Australia, fixed and variable, for every household that has a mortgage. And basically, interest rate increases by the RBA last year increased that average interest rate by 2%. So it went from 2.7 to 4.7. Now, without the RBA raising rates any further, the movement of fixed rate loans, low rate fixed rate loans into higher rates as they refinance this year will add another 0.45% to that average mortgage rate, and then another 0.25% next year. So cumulatively, like another 0.7% on the two, which is like another 1/3 tightening on this sort of measure. So this just gives you an order of magnitude of what that signifies. And so it's like the RBA increasing rates another 1/3 of what they've already done over the past year. So it will be another de facto tightening, if you like. Now, will that cause a recession? No, I don't think so. It's going to hit hard a narrow slice of households, many of which will be on the front page of the newspaper and current affair and all those various media programs. But as a percent of the overall number of households, the 8 million households in Australia, it's still going to be relatively small. So again, as I've said in the past, monetary policy is very unfair. It's hitting a narrow slice of households particularly hard. And the other point is that provided wage inflation stays benign, inflation starts coming down, if it turns out that consumer spending is pretty hard hit by this, RBA will change course and provide support. So provided inflation is moving in the right direction, inflation remains low, wage inflation remains relatively contained, the RBA can come to support the economy if need be, which is not the case as much in the US, because where wage inflation is still somewhat higher. And we are already seeing signs of the slowing in consumer spending. Most importantly, you saw here that in the December quarter, real spending was only up about 0.2%, and the RBA estimates that real spending, consumer spending, will also remain weak in the March quarter. So unlike in the US, consumer spending in Australia is slowing. It is what we want to see. It's why the RBA has raised rates. We want to see a soft landing in our economy to ensure that wages don't get out of hand, to ensure that inflation does start to come back down from pretty high levels. In terms of the market outlook, I'll just I'll quickly conclude with a couple of slides on the equity market. Again, this is the US share market. It's still trading at a pretty elevated. In fact, if I updated this slide for the latest reading, it would be trading at 18 times earnings. The equity risk premium is pretty narrow. Earnings growth has come down, but the markets are still expecting flat earnings growth for the US market this year, and then a 10% bounce back in earnings next year. So you can see this expected level of earnings in 23 is now touching the level of earnings expected in 22. So flat earnings, but then they bounce back. But in a recession, that is still vulnerable to more downside downgrades to the earnings outlook, because in a recession earnings will fall, they won't rise. And also the PE valuations where they are vulnerable to coming down in a hard landing as well. So the US market is hoping for a soft landing. Equity markets are priced for a soft landing. The way to reconcile the fact that bond yields have fallen, I'll just see if I've got a bond yield slide here. Yeah, so you can see bond yields have sort of come down, now down to around 3% in Australia. In the US, they're down as well. The way to reconcile the decline in bond yields with the equity market holding up is if inflation does drop like a stone over the next few months. If it doesn't drop like a stone, one or both of those markets are wrong. Either the bond market is going to have to price in more rate cuts, or growth is going to slow pretty quickly, so that having the rate cuts in place is correct, but the equity market is then mispriced, and the equity market will need to come down. So that is the situation at the moment. So just to summarize, again, and the other point here, the final slide, if a recession is coming, historically, the US equity market has never bottomed before recession has even begun. So if a recession is coming, the bottom we saw in the markets late last year, you can see it here, is unlikely to have been, to be the end of the bear market. There's probably another risk of a downturn. Markets are forward-looking, but they're not so forward-looking that they price in all of the decline in equity prices even before a recession has begun, as you can see in these examples here during previous recessions. So just to summarize, the banking issues, you know, Silicon Valley Bank was very much it was a rogue bank. And the government have moved quickly to limit the risk of further bank runs and probably unwarranted bank runs by providing this lending facility. But the problem is, on the underlying problem still in that case, is that their deposit base is under pressure. They're losing deposits. They're needing to offer more competitive rates on deposits, jacking up their lending rates and tightening their credit conditions. And so that in and of itself will help to slow the US economy. May mean that the Fed needs to do less work, but either way, some think somewhere needs to do the work to slow the economy, is the problem. The global banks, I think, are still in a pretty healthy position, and our banks especially in a very healthy position. So I think that should be reassuring, at least that we're not on the cusp of a GFC Mark II. That's pretty much it. But I said, so the banking issues, that's that. But the underlying challenge for our global markets, the underlying challenge for all of our investment exposures at the moment is still the stickiness of US inflation and the likely need as a result for a hard landing in that economy, which will reverberate across to us as well. I will leave it there.
Excellent. Thank you so much, David. And look, we do have a few questions, have a bit of time to cover a few of these off. There was a few questions just around, I know that you noted that, you know, the Australian banks are a lot stronger, but just questions around the regulatory differences between us and those sort of regional US banks. You mentioned, you know, Silicon Valley not to marketing those fixed income instruments. Yep. Is that something that the Australian banks have the ability not to do, or do they have to do that?
We have to do it. I'm just finding the right. Yeah. So basically, yeah. So just on that, I mean, so again, if you're a bank and you take in deposits, you can lend out that money. You know, lend it out to homeowners or to businesses, or you could go and buy higher yielding securities. And there's some banks like Silicon Valley Bank, they ended up using a lot of their deposit funds to buy fixed rate securities like bonds, mortgage rates. Now, as you may know, if you buy a fixed rate security and the general level of market interest rates goes up, the market value of those securities goes down. And all major banks around the world are required on a quarterly basis to market the value of their assets. So if the value of your bonds goes down, which causes a loss, you have to realize that as a loss. Now, what many banks do as a result is they hedge that risk. And so they'll have hedging in place such that, look, if the value of bonds goes down, it's offset by the gains they make on their hedge, such that they're a little bit insulated from the volatility. So all major banks around the world are generally required to market those assets. And as a result, they either take that as a risk, or they hedge some of that risk. Now, in the case of the US, banks under 200 billion in assets were not required to market those assets, provided they said that they were holding them to maturity. and they could put them in a special account and say, these are assets that we don't intend to sell. We intend to hold them for the long term. And under those conditions, they weren't required to mark to market. But that then left them vulnerable if they did need to sell them, for example, if they were losing deposits. And that's exactly what happened with Silicon Valley Bank. But bottom line, Australian banks, we don't, our banks don't invest that much money in these securities anyway. Most of the money goes toward residential lending. But even to the extent that they do, there are definitely provisions in place to limit any risk on that front. And in fact, as I point out here, if you read here, Australia is the only jurisdiction in the world that mandates banks carry capital to address the risk of rising interest rates as part of their core capital requirements. So there's an extra capital buffer that banks must have to insulate them from the risk of rising interest rates and what impact that might do on their asset valuations, not just mark-to-market securities, but just generally the value of assets in general from rising rates. So that's one point of difference. The other point of difference, APRA allows a narrower range of assets to be considered liquid. So all banks have to have a so-called liquidity coverage ratio. So a certain percent of your assets must be held in liquid assets that can be sold quickly and raise cash if need be. We have a narrower definition of what can be considered liquid. And so, for example, corporate bonds and residential and commercial mortgage-backed securities in Australia cannot be considered liquid assets, whereas in some other countries, banks can consider them as liquid assets. So again, we have a stricter definition. And as I pointed out before, APRA requires major banks to have capital ratios around 1.5% more than required by Basel III requirements. And Basel III is the globally agreed benchmark for banks in terms of their minimum capital requirements. And in fact, so as I said, Australia are in the top quartile of banks in terms of their capital coverage.
Excellent. And you sort of referred to there as major banks or major Australian banks, like obviously highlighting the big four on that chart of where they sit globally. There has been a couple of questions, just I guess comparing that to your regional banks, your investment banks like Macquarie. Is there greater risk in those banks, given do they adhere to the similar sort of standards of that 1.5%?
Look, I think in the case of Macquarie, that would be true. I think Macquarie is counted, yeah. So as a major bank, look to be, yeah. So I think that is in the main true. Now, some of the smaller banks, their capital requirements are not as onerous, but they're still certainly tightly regulated.
Excellent, thank you. There's a question here just around the housing loans part that you covered there, but asking, are business loans in Australia at similar levels to housing loans? And does this, I guess, pose that same issue around refinancing on the business loan side?
You mean as in, is the interest rates at similar levels, or? No,
I guess that the problem or issue that might face, housing loans in terms of these increasing interest rates, is it at similar levels for business loans too?
Look, my understanding is not. I mean, so, most business loans are, generally are variable rate mortgages, a shorter term variable rate lending. So there's certainly not a lot of discussion or concern about, the repricing of commercial lending generally. Think that's sort of not big an issue. I mean, one issue out there I haven't mentioned is, again, I don't think it's going to be an issue. The general increase in interest rates over the past year, plus the work from home phenomenon, which I think we'd all agree has been bigger and more enduring than anyone expected. I think during COVID we thought this would be a temporary thing, but the new normal now is for many people to work 1 to 2, possibly 3 days a week from home. We're seeing around the world vacancy rates in offices come down. Businesses are finding they don't need the office capacity that they thought they needed. So interest rates going up, vacancy rates coming down. There's going to be a major repricing of office valuations, for example, and which is happening in the listed market. but there's many unlisted, many funds and, some even Australian super funds which are holding unlisted commercial property, office blocks, for example, and even more generally, unlisted assets that haven't repriced, and even infrastructure. So we don't have a work from home problem, but they do have the increase in interest rate problem. That there's going to probably be some repricing in those areas, and there is a debate, as to what extent these funds are marking these assets down quickly enough and appropriately enough. And APRA are certainly looking at this. There was a case a few months ago where a super fund in Australia, industry super fund, not to target industry super funds too much, but they've availed themselves of the ability to invest in unlisted assets to a great extent over recent years, and this is going to be potentially a challenge for them. They were going to sell a property. They didn't like the price they were going to get for that property because it meant that they may need to mark down the value of all their other properties on their portfolio, and they pulled the sale. So we'll, and that's an ongoing issue. So yeah, so the repricing of assets, certainly unlisted assets, because the listed market reacts. People hate the volatility of the listed market, but say one thing for it is that it does revalue assets quickly. When you have an unlisted asset and you have some, independent valuer, quote unquote, valuing those assets, questions are, I think, raised about, whether they're being adjusted accordingly.
Excellent. There's a question here just saying, I guess, are you surprised that residential property markets are sort of bouncing back more recently, given all the headwinds? And
yes, look, it's look, the Australian market, we have very tight supply, so there's still people that want to buy properties. Look, I think there's a little bit of animal spirits here. Obviously, the fact that the RBA has announced a pause in rates, there's some people probably thinking, well, I better get in quick, before property prices take off. But I think what we'll find over the next few months is that property prices are still very, very expensive. It's still very hard to afford to buy a home, given the prevailing level of interest rates. At the same time, the economy is going to slow. I'm not foreseeing a recession in Australia, but below trend growth, a slowing of growth, a moderate increase in the unemployment rate. And given very poor affordability, it's hard to see a major, rebound in the housing market. But certainly, I think the market, broadly speaking, can bottom out here. The major negative from interest rates is being removed. It can bottom out, but I just can't see, 10 to 15% rebound in property over the next year.
Excellent. And just looking at inflation, there's a question here, given that OPEC came out and said they're restricting their oil supply. Is this going to, I guess, embed inflation further, or is it further issues for global?
Yeah, look, so we were assuming that oil prices they came down nicely last year, helped headline inflation come down. So headline inflation around the world, which includes food and energy directly, and energy, largely oil prices, has been coming off nicely because oil prices, after surging the first half of last year, did start to come off in the second half of the year. Now, if they bounce back up again, you may see those headline rates of inflation also bounce back, which would be very problematic for central banks, just, I guess, underlie their determination to see the economy slow and need to raise interest rates accordingly if growth doesn't slow. So we'll see how that plays out. I mean, the oil prices, if you do get a hard landing, will come down. But again, at the moment, what we're seeing, I think, is without a marked slowdown in global growth, the oil market is still pretty tight, and certainly OPEC have pricing power, and they can tighten up conditions and push oil prices, at least support oil prices, given the decline that we've seen.
Excellent. I think we've got time for one more, and it's, what are the potential implications of a US recession on Australia's balance sheet, given significant spending pressures in the budget?
Oh, so yeah, so a US recession would slow global growth. It would hurt commodity prices, iron ore prices. I haven't mentioned China, but basically China is reopening, which is great. We haven't seen any major new fiscal stimulus packages from China. Suggests to me they are sort of starting to accept a more moderate pace of growth. They're not going to be the growth juggernaut that they've been in the past. They are nursing a high level of debt in the property sector, and they don't really want to sort of flick the switch and re-stimulate and create more debt problems. So I think China will, will be a positive for us this year, but not offset the impact of a harder landing in the US economy. And as a result, net, I see iron ore prices, which at the moment are remaining pretty resilient, $120 a ton, eventually coming down. So yes, it'll make the budget. See, the problem we face with the budget, of course, is that if the budget blows out, we already have a high deficit. If it blows out because growth slows, governments can't then turn around and cut spending and raise taxes if it's because of a cyclical weakening in the economy, because then it becomes pro-cyclical. And that's why, look, I've been critical of the new government because, they've talked the talk, they talk tough about the budget challenges ahead. But in the first budget, so far at least, they've done very little to tighten the budget at a time when the economy needed to slow. We wanted the economy to slow, and we're having the RBA do all the work, and fiscal policy could have done some of the work but didn't. So now if we get a downturn which blows out that budget deficit again, it's going to be hard for them to and nor should they. I mean, once that happens, they should not tighten the belts, because that would be counterproductive. But it just shows you, it's in a way, the past year has been a missed opportunity for the government to tighten the budget, and would have taken some pressure off the RBA. End of the day, the more that fiscal policy does, the less monetary policy needs to do, and it would have been a fairer way to slow the economy as well, because as I pointed out before, monetary policy hits a narrow slice of households, so it's more unfair in its burden, if you like. On my soapbox today, aren't I?
Yeah, exactly. No, perfect. Well, again, thank you so much, David, for taking the time for this flash webinar. And as you mentioned before, we do have your more formal quarterly webinar coming up, so that invite will be coming up very shortly. So look for that in your inboxes, or jump on the website to register for that. Thank you, everyone, for attending today. We do appreciate taking your time. And yeah, hope you have a good week. Thanks.
Bye for now.